Welcome to Brokers Digest, a weekly webcast by the Hedge Singapore, where we discover stock opportunities with you.
Hello and welcome back to this week's Brokers Digest. I'm Gula Warden, and in this webcast episode, we'll discuss with Chris Brankin, CEO of TD Ameritrade, the recent frenzy for options and what it means for the market. Hi, Chris. Hope you've had a good start to the week.
Yep, good morning. Thanks. Our fourth of 13-week series. So excited as our last one for the month of September.
Okay, great. Okay, so before we jump into this week's topic, last week we asked viewers what they looked for in their investment strategy, yield or growth. So our poll results showed that 46% of viewers are more interested in yield stocks and 54% in growth stocks. So I hope that shows that we've got a lot more younger viewers than older ones, because I always thought older ones like yield. Now, our audience had some questions after last week's episode. There were a few yield questions, valuation questions, and a couple of growth questions. So I've taken the liberty of amalgamating the topics. Now, we also had a question on financial assets. So how would you now value a financial asset? So let me take that one, Chris, and then you jump in if we need any further information. So quickly on financial assets, I guess it would depend on whether it's a stock, bond, a derivative, and what the underlying asset is. So QE has impacted interest rates, but still most assets take their value from the underlying, which gets its net present value from cash flows and the discount rate. Now, up to a point, the interest rate environment affects discount rates. So if it's a bond, it would depend on the ability of the underlying to pay the coupon, and hence would be priced accordingly. And the pricing of a bond also depends on tenor, ratings, covenants, and the yield curve. So for derivatives, these are financial contracts, a little bit more complicated to value them, and they're used for a variety of purposes, and the prices are derived from some underlying asset or security. Once again, okay? So depending on the type of derivative, its fair value or price will be calculated in a different manner. Then we have swaps. Swaps are price based on equating the present value of a fixed asset and a variable stream of cash flows over the maturity of the contract. Futures contracts are based on the spot price along with a basis amount, while options are priced, and we're going to talk about options in a little bit more detail very shortly, while options are priced based on time to expiration, volatility, and strike price. Anything to add to that, Chris?
Yeah, look, I think when you look at it, so this is something we explain to people all the time, whether you're investing into stocks, options, bonds, any type of financial asset, we always tell, look, if you don't understand the risk, well, then either learn about what the risk is before you invest in them. Because each one of these things that Gula had mentioned, all have different little nuances and different, valuations that maybe give that underlying value. So that's something that's really important, is make sure you're educated on terms of what you're actually trading before you kind of jump in the deep end.
Okay, so then we've had these other questions. Okay? We've had a question on valuation. What's a reasonable valuation for a tech stock? We've also had questions on which are the best yield and growth stocks. So what we've done is we are re-showing this to show that first. Yeah. And yeah, just a point to note about any company, cash flow is the lifeblood of a company. So for growth stocks, investors may want to pay attention to cash flow statements, operating cash flow, free cash flow, in addition to the company's ability to generate revenue and profits. Chris, what are your thoughts on these US mega growth stocks? And they're very familiar names to all of us. I mean, a lot of us have used Adobe, Amazon, Facebook, PayPal. Yeah.
Well, look, you'll notice a trend to these mega cap growth stocks. A lot of them are in the tech space. And when people are talking about, hey, our valuation's getting stretched in some of the tech names, I think that's difficult to look at. From a normal PE ratio, sure, they're probably getting stretched. But I think, on a normal sense, there's not as much potential or upside that some of these tech names, that have, across the many aspects that they touch, whether it's cloud, whether it's services, gaming, all these different things have a huge potential that are throwing some of these standard PE ratios that you would look at on a historical type basis that are just significantly higher than what you would expect. So I would say, look, don't worry as much about the PE ratios on some of these tech names, because a lot of that's based on potential. And if you look at Amazon from years ago, it was a negative PE ratio. You look at Tesla right now, I mean, the PE ratio is some crazy number that we've never seen before. So I think you can't just put all your eggs into that basket of the PE ratio when you're looking at some of these mega cap growth stocks.
Okay, so we've got the top 10 big cap growth stocks. Yep. So they're here. Yeah. So do we have any thoughts on them, Chris?
Well, I think, look, so if we look at what our customers are trading at TD Ameritrade, a lot of these names are some of the most popular net new buys, and they have been kind of over the last, we'll call it almost the COVID-19 period, over the last 6 months. Well, we see a lot of these names are being actively traded. Now, as we start to get into that survey type question that the Edge had asked the viewers last week in terms of, are you looking for growth or are you looking for yield? I think a lot of that, it will, kind of bubbles down to, what parts of the economy or sectors are you more confident in? Because you can't just simply chase yield or simply chase growth. I think as we look at some of the sector rotation, we have some of the, the names of people have taken some profits off of those large mega cap stocks like the tech names, mainly the FANGs, and have rolled into some of the more type of cyclical names or more names that maybe have been a little bit more under pressure. And some of those areas in energy or in the telcos in the US have larger yields right now. So the yields look relatively attractive to some of these sectors that have been under more pressure than the tech sector, which has just set record after record over the last few months.
So we've got the top 10 mega cap yield stocks. And over here, so you can actually, with this table, you can actually check whether the company is still able to pay out its dividends, because it still makes a profit. And there's earnings growth for many of them, and there's a cash flow yield as well. So they are cash flow positive for many of them, and also a dividend yield. So Chris, you mentioned the telcos, and they are there. And as you said in last week's webcast, these look very much like Warren Buffett's stocks.
Yeah, well, absolutely.
His portfolio, yeah.
Especially the large banks. Like the big banks in the U.S. Significantly under price pressure over the last number of months. With the Federal Reserve basically cutting interest rates to about zero, and have kind of going out and saying that like there's probably no raise in rates until the first quarter of 23. I mean, so we're looking over the next couple of years, we're pretty stagnant in terms of inflation, in terms of where the rates are. So these big banks have been a little bit under pressure, which has shown their yields to go up significantly in price because their stock price dropped. So that's important. Okay, so their stock prices dropped a significant percentage amount, but they've maintained their dividends where they have them. So as long as a company, you're confident in their free cash flow, and if they have a historical track record of maintaining their dividends, like JP Morgan, Bank of America, I think these are great names in terms of what's in Warren Buffett's portfolio. And they've had a historical track record of maintaining their dividends, because dividends, I always like to point out, can be removed or reduced at any time. So these large, big banks in the US, the telcos, even some of the other cyclical types of names that have been under pressure, we do see a little bit of more interest in our trading from our clients at TD Ameritrade and from investors around the globe as they look for a little bit of yield and as they maybe take some profits off the table on the unbelievable tech rally that we've had over the last 6 months.
Thanks for that, Chris. So we'll come to the main topic this morning. this afternoon, and it's on options. On September 7th, it was reported that SoftBank spent about $4 billion buying call options on tech stocks. And SoftBank was referred to as the NASDAQ whale, but it appears, obviously, it appears that along with SoftBank's purchase, there was a shoal of smaller frenzied fish. So we've got a chart here on the largest tech ETF, and so the options frenzy is illustrated by the open interest of Triple Q. It's one of the ETFs, a popular ETF by Invesco. So, Chris, what has been driving this interest in options, and why have retail investors all waded in on it?
Sure. Look, options, trading on U.S. markets over the last 2 decades has shown unbelievable growth, many records over the years. And there's a few reasons, I think, that why this has been such a opportunistic area that have continued to drive investors to. And a couple main reasons that I like to look at is number one, is you could have risk-defined strategies. I'll explain that a little bit more, but you essentially can, it doesn't have to be unlimited risk on the upside or downside. You can have your risk defined for you at the start of your trade. And the second, and probably the more powerful part of that equation is the conservation of capital. You have to outlay significantly less money or have significantly less money invested into your portfolio to control the same amount of shares, whether you think the markets are going up or going down, or there's even some strategies if you think the market is staying neutral. And you can do that with significantly less capital outlaid to control the similar type of position using the option strategy markets. Now, an area that we talked about before the show, Gula, that I think people in Singapore and around the region are a little bit more familiar with, if they're not familiar with U.S. trading options, is CFDs. So similar to a CFD, but some key differences. So the options on the U.S. markets trade on a centralized market. Now that's very important because you don't have liquidity risk of trading with your particular broker. It's a lot easier to get in and out of the position, especially in times where there might be some volatility. You have standardized expiration, which is very key in terms of how you're getting in and out of the markets. There's no hidden finance costs, which you will see in CFDs. So CFDs commonly will say they don't charge a commission. That's because it's baked into their finance cost, or what we like to call the spread between the bid and ask. So some key differences there, but really important, I think, is trading on a centralized exchange, not having those hidden finance costs and having that standardized contract and expiration are some key differences that why we see more and more people that maybe were used to CFDs flocking towards the options market.
Okay, so also with options, the downside is limited, and even if you buy a put option, isn't it? Whereas CFDs, for some of these trades, there is unlimited loss.
There is. So I think there's a number of different ways you're able to trade options. So we see from our customers, and the people that we see have been the most successful over the years, is they're using risk-defined strategies. Now, whether that's simple, options 101, as we like to call it, whether you're buying a call outright or buying a put outright, whether you think the markets are going up or down, the amount of money that you pay for those calls or puts at the beginning of the trade is the maximum amount of risk that you would have you've outlaid at the beginning of your trade. Now, there are some other more riskier type strategies you're able to use, but what we also see people is they use it to hedge their overall market portfolios. And you're able to do this through a number of different tools and strategies that are available. And what we like to actually teach at TD Ameritrade, and you also have this unbelievable options education center that we put together on our website that allows anybody, whether you even have an account with us or not, as long as you're registered, to go in and view all the hundreds of videos and articles and different things that we talk about, not only strategies, but how to use our trading platform and how to unlock the different levels of options capability that you would have with an account with us at TD Ameritrade.
Okay, so before we move to the next section, we would like to ask our viewers to take a poll. We would like to know your take on options, so you can choose your answer in the poll now. Okay, thanks. So, Chris, there was a question from last week on options. How do you determine what option expiration to purchase?
Sure. No, that's a common question we get all the time. I would say, if you look at a chain of options, you'll see all these different expirations with a little number in parentheses next to it. That's the number of days till expiration. Some of the most commonly bought or sold options are generally in that 30 to 45 day window. And I say that because that's when you start seeing theta or time decay really start to kick in, is in those last few weeks before the option expiration. And that's where most of the options activity is being traded on a normal occurrence. So in that, we like to call the front month standard expiration option, generally around 30 to 45 day period out, that's where you see the number one kind of open interest that we highlighted earlier, the number one volume for trading, and you see the most price movement as you get closer and closer to that expiration period, as the intrinsic value is basically what's remaining in the option at that point.
Okay, thanks. So I think with that, unfortunately, we've run out of time. And
my answers were too long today, I guess.
No, it's okay. I think I shouldn't have spent so long on that financial asset valuation question too. All right. So we'll talk to you next week. So everybody, like us on Facebook to get alerted on next week's episode. And if you have topics you wish for us to discuss, do leave them in the comments. I'm aware that one of them is, where do you think the Dow Jones Industrial Average is heading, and what industries are likely to do well in the future, especially the next 3 years? And we'll address that. We'll address that maybe next week. Yes, Chris?
Yes,
okay, so,
sounds good.
Yeah, good. Okay, thanks. So see you next Monday, 5th October. Everybody, make a point to tune in. So it's bye from us in the studio, and bye from
so
Chris.
long from Chris from my home. Thank you.